Hey everybody, Dr. Tom Gerard here, and we have a really important chapter coming up, and this is the chapter on internal controls. And this is where you're introduced in taking care of one of your most important assets in your company, and that is cash, right? And even though we operate in a kind of getting a cashless society where we use a lot of electronic funds transfers and those kinds of things, eliminating people handling cash that work in the organization, but we still have to monitor the electronic transactions, because now maybe you're monitoring how the credit card processing companies are moving your cash from one business stakeholder to another. And so you still have to keep track of that, even though we're not handling what we think of when we think of cash, like money in our pocket. Cash money in our pocket is obviously a very big, important piece of it. But just because we're not handling greenbacks, as we used to call them, right? We're still having to manage cash, because cash flow, whether it's being taken by credit or debit card or PayPal or any of the other newer money transfer electronic systems, we still have to keep track of it and monitor it. And so let's take a look real quick. Now, one of the things that you're introduced always in this chapter is the Sarbanes-Oxley Act. Now, that is legislation that went through Congress quite a few years ago now, but it's also called SOX, S-O-X for short, and there's a lot to it. The main thing that you need to remember is this is primarily geared at for-profit publicly traded corporations. If companies are traded on the stock exchange where people buy and sell stocks, whether that's New York Stock Exchange or NASDAQ or whatever, they have to follow the Sarbanes-Oxley Act. Other businesses don't necessarily have to follow the Sarbanes-Oxley Act. So that's one thing to keep in mind. We're not talking about every single company out there. However, it's a very important legislation that came about because of a lot of fraud. And of course, we could do many more videos and discussions on that, and you can watch some videos on YouTube about that, and some in overview and some in great detail. But in objectives, one of the things that I have to tell you, when you think of an auditor, many people think of the auditor of, IRS auditor. Oh my gosh, my taxes are being audited, and I need to go because I got audited. But the truth is, many companies, in fact, smart companies have what we call internal auditors, because there's external auditors that's required by the Sarbanes-Oxley Act to audit your financial statements to make sure that they're done correctly and legally and properly. But you don't ever want it to come out in your financial statements that the auditors found something that was kind of questionable. So what do? You hire an internal auditor. You have an internal auditor or maybe a whole department. My first job in accounting was as an internal auditor, and I worked for the auditor controllers department, and they were internal auditors. And so even though there was accountants in all different divisions and different parts of the organization, we had an entire division of internal auditors. And why is that? Because number one, we want to control our cash and our accounting procedures, but we also want to catch any mistakes before it goes to the outside auditors. Because imagine if you're a company and you're on the stock exchange and you're wanting people to buy your stock and have confidence in what you're doing, that you're doing a good job, but something comes out in your financial statements by the external auditors that says, well, maybe there was something they were doing that just wasn't correct or didn't look right. We don't want that, because that's going to instill doubt in the minds of our investors and our stakeholders. And so we have an internal auditor that audits all of these things before it goes to the external auditor to catch anything inside. And so that's a really good thing that a lot of companies do to prevent anything from coming out in their financial statements that looks fishy, or not necessarily fishy or illegal even, but we want to keep control of all of this. Now, we also talk in this chapter typically about bank account reconciliation. One thing to remember about the bank is, and we talked a lot of in accounting, we follow a timed thing, the period mentality, whether that's a month, a quarter, or a year, the time frame. And so think about the bank keeps track of your money. You have your money in the bank. Again, it could be electronics funds transfer that put it there or took it out. That's not what we're talking about here. We're talking about the bank is keeping track of your cash that's in we're going to call this asset cash, even though really it's just a piece of paper that says you got so much money in the bank, right? But it's your cash, and now you have your accounting system, and you want your accounting system to match the bank. And what happens a lot of times in the accounting system is, because we're working in this timed environment, the last day of the month comes and the bank says, okay, no more transactions, we're cutting it off. But in your accounting software system, at your organization, maybe you have transactions that's in transit, or maybe you have transactions that didn't get posted right. Whatever happens, maybe things got posted twice. That happens too. The higher you go up into accounting, the more time you spend fixing mistakes of people, and just find software mistakes, all kinds of mistakes. And one of the most important areas is reconciling with the bank, because you're not going to be able to say to the bank, hey, could you please modify my bank account because we had a deposit that somebody was supposed to drop off at the drop box at the bank, deposit for this month, for last month, so to speak, and we didn't get it in on time, but we really want that cash to be applied to our last month. And that's the way it is in our financial records. We just didn't get the money to the bank, or maybe had a check that came in, or some kind of electronic funds transfer that didn't get posted at the bank. You're not going to be able to call the bank and say, hey, can you please modify your banking records to match our software and our accounting records? Well, no, of course not. You have to modify and change your accounting records in your organization to match what the bank says. And so you get into a lot of that into this chapter. It's a great one, very, very important, because like we talked with inventory and merchandising businesses, it's one of their largest assets. And in many companies, especially now when there's big corporations sitting on lots of cash, managing it and protecting it is very important. And that's what you cover here in this particular chapter.